Good morning, ladies and gentlemen. Thank you for coming today to attend this event. My name is Khaldoun Azhari. I am the president of the Correspondence Club of Japan until Friday evening. We have another round of elections. Today's event is about the trade wars, basically, and about other issues related to economy and finance and some related evaluations. Our main speaker, today is Mr. Paul Gruenwald. He's a chief global economist at Standard & Poor Global Ratings. It's very well-known agencies, and most of the financial and economic reporters, we have to depend on your ratings all the time. And trade wars, currency wars, and perhaps infrastructure wars coming up soon between China and Japan, and also other conflicts, all threaten Asia's economy as the region seeks to cope with the fallout from Trumpism and other challenges. We know that American President Trump is trying to impose some tariffs on many products, and other companies are revenge, and other countries are revenge against that. Our main speaker today is a chief economist at Standard & Poor Global Rating based in Singapore. He leads the economic research agenda and serves as a primary spokesperson on macroeconomic matters for the company. Before joining S&P, Mr. Gruenwald, he spent almost 5 years at Australia and New Zealand banking group, ANZ, and as an Asia-Pacific chief economist, where he was responsible for helping set and direct Asian global economic research agenda there. And he also served in many other important positions, including at the IMF Asia's section. And without further ado, ladies and gentlemen, please welcome our guest speaker today. Thank you.
Okay, thanks very much for that introduction. It's a great pleasure to be back at the FCCJ. I was told I have a half an hour to present my stuff, and then we'll open it up for Q&A. There's obviously a lot going on in the world, so this is going to be, I guess, 2.5 sections. I have to open very briefly with what's going on globally. That will feed into the trade wars, which is section number 1, and then the Belt Road Initiative coming out of China is section number 2, and then we will go to questions. Just to set the stage, we do an exercise every quarter at S&P, which we call our Credit Conditions Committee, and we just look at the world, and like a lot of people, we're actually more worried about the risks than we are with the baseline forecast. So these 4 dots on this slide, most of my slides are nice looking charts, by the way, but this one isn't. These are the main 4 risks we're seeing in the global economy, more or less in order. Not surprisingly, the escalating trade wars and what they could do to the macro outlook are the number 1 risks. Risk number 2, which used to be number 1, is a disorderly deleveraging process in China. That's a multi-year process, but so far has been reasonably orderly. Credit cycle appears to be turning. We are a rating agency. Our analysts do obviously pay attention to what happens when growth slows and interest rates rise. I'm not going to talk too much about that. I'm not a ratings analyst, but we do flag that as a risk. And then North Korea, which, to be quite honest, was a tail risk. I think it continues to be a tail risk, but after the summit last month, Kim Jong-un stayed 2 blocks from my apartment in Singapore, and Donald Trump was about a kilometer down the road, so lots of excitement in my neighborhood, and we'll see how that one plays out. So let's go to the global growth view. We were telling this very, well, before I go to that, I have to show you my official numbers. We just revised our growth forecast a couple of weeks ago. Since we're sitting in Japan, I can tell you that we lowered Japan's growth forecast by about a half a percentage point to 0.9. We all know we had a sluggish start here with a contraction in Q1. Q2 looks a little bit better, but given the weak starting base for the year, growth should come in at about 1%. But the drivers of global growth in order continue to be China, India, and the US. Most people don't think that way, but those are the three countries that are driving the global economy. I don't have India on this page, but China's about 6.5, India's about 7.5, and we've just raised our US growth forecast again to 3. Globally, we're about 3%. This was actually a nice looking chart until the latest quarter because everything was going up together and we were all excited about the synchronized global upturn, and that looks like it's at least partially not unwinding but fragmenting. We did have a weak Q1 in Europe, even a weaker Q1 in Japan. US, at least for now, is going the other way with the tax cuts. I wouldn't throw in the towel yet on the synchronized global recovery based on one data point, but that nice narrative we were telling a couple of months ago is off the front burner for now. But again, I'm not going to spend tons of time on that. And then just to compare the US and Eurozone and Japan, if we set GDP equal to 100, if we make kind of an index right before the global financial crisis, you can see that the US economy is about 15% larger than it was before the crisis. It has been a very long, very shallow recovery, which is one reason we have not seen a lot of inflation and wage pressure. But if you look at Japan and Europe, they are only about 5 or 6% larger than they were a full decade ago. So we've made some progress, but not a ton of progress on the current recovery. Most of the action has actually been in the emerging markets, to be quite honest. I'm going to skip that piece on balance sheets. And just to kind of finish up this section, this is the contribution to global growth. So the way to think about this pie chart is think about, building blocks, and you're building up to the global growth rates. China alone contributes about 1/3 to global growth. So I will say that again. China alone contributes 1/3 to global growth. So even if some people don't like China, you wouldn't want to wish the largest contributor to global growth to get into too much trouble, because that is not a China problem. That is an everybody problem. India is second. India alone contributes 0.5% to global growth. If you lump all of the advanced countries together, that's about 0.7. But just to gain some perspective, I was in India a couple of weeks ago, and I made the point that China and India alone are 1/2 of global GDP growth. So those two big emerging giants in Asia are really driving the global growth picture. So with that background, I want to talk about trade. Everyone's talking about trade. So I wanted to show you guys, before we talk about the scenarios of the so-called trade war, I wanted to show you how much China has actually changed over the last decade or so. As Kaldam mentioned, I used to work for the IMF. I was running the Hong Kong office about 15 years ago, and then I was running the regional outlook for the IMF for Asia about 10 years ago. And there was a lot of noise about China back then, manipulating its currency, etc. There was a lot of validity to those claims, but the point of this section is to show you that that is very old news. So this is very simple, but it's a way of illustrating that China is becoming a much less trade-dependent economy. So the black line in this chart shows Chinese GDP as a percentage of global GDP. So we started 2003, and way back then, China was only 4% of global GDP. Now that number is about 15 or 16%. So China's 4 times as important to the global economy as it was 15 years ago. If you do the same thing for global trade, if you look at China's trade as a percentage of global trade, it's going up, and it used to be higher than the global GDP share, but that's actually flipped around. So as a kind of contributor to global trade, China's much less important and much less trade dependent dependent than it was before. I'm going to show you 3 versions of the same chart, so I'll just kind of beat you over the head until you hopefully agree with me. Here's another way to look at it. This is what economists call trade openness. So what we do is very simple. We take a country's exports and imports, and we divide that number by GDP, and we call that trade openness. That ranges from 0. If a country doesn't trade with the rest of the world, that number is 0. Some countries are up at 200–300%. A small open economy like a Singapore or a Malaysia or Hong Kong, that number can be as high as a couple %. The reason I'm showing this to you is if you look back here, again, about a decade ago, China's exports and imports were about 65% of its GDP. Okay, that was the height of China's, currency manipulation, trade driving growth, et cetera, et cetera. That number has fallen all the way to about 35%. So in the span of a decade, China's measure of trade openness has fallen by 30 percentage points, which is quite staggering. It's now below the global average. The global average is that orangey line there. And the rest of Asia, which is the red line there, really hasn't slowed down. So China's kind of diverged from the rest of Asia. The rest of Asia continues to become more open, with trade being a bigger part of its GDP. And China's taken a massive plunge. That really reflects a couple of things. One is China's rebalancing toward a much more consumption-based growth model, and 2, what we call the onshoring of production chains. So whereas 10, 15 years ago, China would import a lot of components from Korea, from Japan, from Singapore, from Taiwan, etc. It still does, but much less of that's done cross-border, and more production and more supply chains actually take place in China itself. And this is the other way to look at it. This, again, is the contribution to growth. The chart here on the right, that's the bar version of the pie chart I showed you a minute ago. So it's kind of, we changed our colors last year. We have very dark and edgy colors now, so they're hard to read on the chart. But the black bar there is China's contribution to world growth, and the red bar is the rest of the world. So if you eyeball the last half decade, China's contributed around 1/3 to global GDP growth, which is what I told you earlier. It's not too hard to find the global financial crisis right there. If you do the same thing for trade, first of all, trade hasn't been growing very much. And second, China really isn't driving global trade growth. So China continues to be a big driver of global GDP, but in terms of global trade, it's just not doing very much. And if you look at China's own growth, if you look at how much of Chinese growth is being generated domestically through consumption, investment, the usual suspects, and how much of Chinese growth is being driven by exports, other people buying the things China produces, the latter has basically been 0 for about half of a decade. So China's not getting any growth at all on average from the rest of the world. It's totally a domestic story. One other way to look at this is the current account balance. So the current account is basically the trade plus some incidentals. 10 years ago, China was running an enormous surplus. It was about 10% of Chinese GDP. This is when a number of analysts, including my former employer, the IMF, and lots of banks, lots of governments, US Treasury as well, sort of accusing China of contributing in a big way to global imbalances. Again, there was some validity to that claim, but that 10% surplus is now less than 2. So that's really not a lot of evidence that China is causing imbalances in global trade and services. If you want to point the finger at anybody, that's Germany, and Germany's now up to about an 8% of GDP surplus. So the composition, if you will, of global trade surpluses has changed. The U.S., of course, is down here. We can talk about this later. I think there are good reasons for China to run, for the U.S. to run an ongoing trade deficit or a current account deficit. If you want to ask me later, we can come back to that. So this is how we think the trade war could unfold. So these are 4 scenarios. We published these. These are in the public domain. They are not in any particular order. Number one, I think, is fading. This was where the idea that a country can win a trade war is, sort of realized that's not a very good proposition, and a kind of dignified climb down is engineered. Everyone obviously has to save face, but I think we're getting to the point where this kind of limited impact scenario where, governments realize that this thing is not winnable, that is probably falling in terms of probability or likelihood, however you want to characterize that. Number two, I think, is actually, in a way, China's preferred solution to the trade spat. They just want to throw money at the problem and make it go away. So buy some more airplanes, buy some more soybeans, buy some more whatever. Try to smooth things over. This was floated a while ago. I can't remember exactly how many months. The Chinese proposed to pick up the purchases from the U.S. That wasn't terribly well received, so we continue. 3 is probably the highest probability scenario here, where both sides dig in. We start this tit-for-tat retaliation on the trade measures. We move to maybe a less good baseline scenario where growth is slower. It doesn't have to be a disaster, doesn't have to be a global recession, but certainly growth is slower. And then number 4 is the one that I'm actually hoping for, which is mutual self-interest prevails. This isn't just about trade. I'll talk about that in a minute. Actually, I would argue that the issue between the US and China is not trade, it's the investment story, which we still hear about sometimes. It's about reciprocity of markets. If China wants to invest in sector X in the rest of the world should be able to invest in sector X in China. There should be a level playing field for both domestic and foreign firms inside of China, and then intellectual property has to be protected. All 3 of those issues are on the table. All 3 of those could be discussed if we went to a strategic economic dialogue 2.0. Most of you in the room look old enough to remember what happened 10 years ago under the second Bush administration in the US. Henry Paulson was the Treasury Secretary. There was a recognition that the US and China are different countries. China is not going to turn into the US. There are going to be issues that come up. They need to be discussed at a high level. So this framework was set up where we could have regular dialogue between high-level US and Chinese authorities. I haven't heard anyone seriously consider that, but just for the record, that's my preferred solution. This is a slide we made 2 weeks ago, which is out of date. I think it's one of these charts we made on day 1, and on day 2 it was out of date. Back when the number was 50 billion on the table, that was the share of US GDP, 1/4%, and that was the share of Chinese GDP, which was 0.4%. Now I think we're closer to 300 billion, so you have to multiply these numbers by 6, more or less, to get an approximation. There's kind of a joke in the US Congress that one congressman famously said once, if you're talking about spending $1 billion here or $1 billion there, pretty soon you're talking about real money. So if you keep increasing that number there, you're going to actually start to move the macro needle. Again, the trade itself is probably not going to move the macro needle very much, but it's what we call the second round effects. So if we're getting a lot of conflicting messages out of Washington, there's a lot of uncertainty out of trade policy, we don't know where the economy's going, maybe we'll hold back on that big consumer purchase. If the firms see that, maybe they'll hold back on their next round of capital investment. Maybe confidence will drop, and then we go to a excuse me, a lower growth path. Maybe firms will start shifting production in response to some of these tariff wars, and we're starting to see parts of that already. So it's hard to map out exactly where it's going to go, and these things tend to take some time to unfold, and we're still early days. But again, it looks like we're going on scenario 3 in my previous slide rather than scenario 4. And this is the point I mentioned earlier about trade. The US trade deficit actually reflects a lack of US savings. So if the US wants to consume more than it produces, it has to import, right? So if it wants to consume less, it has to save more, which is kind of straightforward accounting, but I never hear this articulated by the U.S. administration. If the U.S. doesn't change its savings behavior and they fix the bilateral trade deficit with China, it's just going to show up somewhere else. It's like, you know, you stick your finger in the dike and the water stops here and it comes out somewhere else. So the solution, if the U.S. is really, administration wants to eliminate the trade deficit, the U.S. has to save more. The other reason that the U.S. runs a trade deficit, and I haven't heard this articulated either, is that the U.S. government produces the world's risk-free asset. I live in a money center, which is Singapore. If you go to any of the global money centers, New York, London, Hong Kong, or Singapore, all these traders and all the fund managers, they love risk-free assets, and the global risk-free asset is a U.S. Treasury. The global risk-free currency is a U.S. dollar. So if folks all over the world want to buy more U.S. Treasuries denominated in U.S. dollars, the U.S. is going to run a capital account surplus, which means it runs a current account deficit. That's just accounting, right? So the fact that the U.S. successfully produces this global risk-free asset, that allows the U.S. to run a trade deficit. So why are they so stressed about running a trade deficit? I don't know. Anyway, so my parting thought here is, do we need the Strategic Economic Dialogue 2.0? Because I think a lasting discussion and a lasting solution to the problem is going to involve that. So that's number one. Let me spend about 10 minutes on number two, which is China's Belt and Road. This is a total gear shift. So I'm going to take a sip of water. Actually, I'll show you a map. While I'm taking a sip of water, you can look at a map. Oh, we lost one of my maps here. That one. Okay, I'll let you look at that map while I take a sip of water. I tell this funny story. When I was in graduate school in New York a long time ago, like almost 30 years ago, at Columbia, when I first went there as a young aspirant economist, on the same floor of the economics department was a geography department. And the geography department was in the middle of being closed down because no serious people did geography. And here we are about 25, 30 years later, and I spend more time looking at maps in the last 12 months than I have in the last 25 years as a professional economist. And the reason and then we've got the revenge of geography and all this kind of stuff going on, and I'm reading lots of books about geography and geopolitics. So a lot of the Belt Road is about maps. So I'm going to show you a couple of maps, but let me go back a stage and just tell you how we're thinking about the Belt Road Initiative. Well, first of all, we're coming at it from obviously an S&P perspective, and we're not just a ratings agency. We've got a big data part of our business. We've got an energy part of our business. So we're all about data, analytics, credit, and energy. So we kind of came at it from that angle, but we focused on three parts of Belt Road. First is what I call Eurasian connectivity. China's a rising power. China wants a sphere of influence. China wants markets for its goods. So, China kind of spreading its wings a bit is one way to think about Belt Road. It's also a way to justify why China's investing in all these infrastructure projects where no one else wanted to do it. So I've been living in Asia since 2001, and if I had $1 for every infrastructure conference I went to, well, not $1, but we've got a lot of infrastructure conferences in Asia, and it's always the same issue. There's lots of infrastructure projects that need to be done. There's lots of money out there that wants to go into infrastructure projects, and they can't ever get together and meet. And the reason they don't regularly meet up is because the risk-return trade-off is not acceptable to the investors. There's just too much risk around politics, environment, legal risk, all sorts of implementation risks, etc. China, by at least one way to think about it, by having this sort of Belt Road, is internalizing a lot of those risks and also playing the long game. So that, I think, is a partial explanation of why they're doing this. Energy security, I'll come back to that in a minute. I think energy security for China is a huge part of Belt Road. And the other thing we're looking at, I mentioned my cynicism at the beginning. I think I mentioned my cynicism, was the credit quality. Are these really viable projects, or is there other sort of forces at play? And I'll take you through that one. So let's go back to my map. This is just one of many maps that's out there. We took this one from The Economist. We gave it attribution, of course, right there. Economist.com. A lot of this is just connecting different parts of China to the Eurasian landmass. So there's books out now about Eurasia, you know, stretching from Portugal all the way to China. By the way, Japan's not on these maps, so Japan is not part of Belt Road. My country, the US, is not part of Belt Road. So we're not used to looking at maps these days. I was in Australia a couple of months ago. The Australians asked if they were part of the Belt Road Initiative, and I said, yeah, you're right in the corner down there. So any Australians here, that's your contribution to Belt Road. But if you look at these projects, I'll show you the energy map in a second. A lot of them have these different corridors, the land corridors, the sea corridors. China's building the biggest dry port in the world there in a city called Korgos on the border with Kazakhstan. So all this stuff is happening. It's multi-dimensional. But let me show you the cool charts since I've been sort of leading you into this. This is actually from a video. This is something that our CEO, Doug Peterson, presented at the World Economic Forum. It comes from our sister company called Platts. If you want the cool video, you can get the link right there and start at minute 21. This is called a geospatial map. So what they do is, this is big data meets geography. If you put this map in motion in the video, you'll see these lines start to move around. Lines, not lines, dots. You see the dots start to move around. Each dot is a transponder on an oil tanker. So you can actually start to see the oil flows go around the world for the last 20 years. So a couple of things to note. If you watch the US, you see a lot of stuff flowing into the US, and then it's slowing down, and then at the end of the map you see stuff start to leave the US. So you can actually visually see the shale revolution in the US convert the US from a big energy importer to something close to net zero. Any Brits in the room, you can see the North Sea stuff happening up here. But as an Asian guy, my eye immediately went to this. This is the thickest line in the world. This is the biggest energy dependency in the world. And right there on the dot is the Straits of Malacca, which is the biggest energy choke point in the world. So if you're in the Chinese government and you're sitting in Beijing and you get 80% of your oil imports through the Straits of Malacca and 50% of your gas imports through the Straits of Malacca, you might be thinking, oh, maybe I need to diversify my risk. So if you look at a lot of these projects for the Belt Road Initiative, they go into Pakistan here to the Arabian Sea, bypasses the Straits of Malacca. They go through Myanmar here into the Andaman Sea, bypasses the Straits of Malacca. They go into Turkmenistan and Kyrgyzstan there, both oil and gas, bypass the Straits of Malacca. They go into eastern Russia up here, bypasses the Straits of Malacca. So a lot of these projects have to do with energy security. I don't have the exact number with me, but the number in my head is over 80% of these projects are some combination of infrastructure, ports, and energy-related infrastructure, which is quite telling. So it's a big part of the equation. By the way, China is going to be, for the foreseeable future, the biggest energy importer in the world. We just talked about China's trade surplus. China runs a structural energy trade deficit, ranges from 3 to 5% of their GDP. And then you'll notice that all these projects, let me go back one. Again, I was in India a couple of weeks ago. All these projects go around India. India is not part of the Belt Road Initiative, but the projects are going above India, they're going around India, they're going through Pakistan, they're going through Myanmar. So India and China are both energy short countries. They are both going to be very dependent on the Middle East. So I think we're going to be seeing a lot more versions of this map in the coming years and decades. As the US becomes kind of energy net neutral, I can see China and India, we already talked about their contribution to global growth, becoming a lot more interested in what's going on in that part of the world. So let me wrap up here, just a couple of things. This is just World Economic Forum infrastructure rankings. We often get the question about which countries are going to adopt the Belt Road. And I thought about that a bit, and it's really going to be kind of a checkerboard. So some countries, Pakistan, Cambodia, have gone full into the Belt Road. There's a lot of Chinese investment there. If they're a checkerboard, they would be sort of a dark color. Other countries, Vietnam has very little. India has nothing. They're not participating in Belt Road. Those would be light colored checkerboards. So if we look at a map, we're going to see different intensities of Belt Road uptake. It's not going to be a sort of a big homogeneous mass. It's going to be different intensity based on politics, I would say based on size, based on external financing need, etc. So how all this stuff is going to play out. A couple of interesting ones. Malaysia was a big adopter of Belt Road under Najib, who got arrested overnight. If those of you, I'm sure all you guys know that, since you're press people. But under Mahathir, he's kind of pushing back on some of the Chinese investment. So maybe Malaysia is going to be a lighter shade of BRI. That kind of remains to be seen. But again, it won't be necessarily homogeneous across the board. So I've been yakking away for 10 minutes about Belt Road. What does success look like? I mean, if we're looking at Belt Road and we're going to say, is this working? Is it not working? Is it a success? Is it not a success? You obviously don't want to talk to the sponsoring country. They'll say it's an unmitigated success. So we should just try to find some objective measures. So we came up with two. First one's financial, and the second one I think can be classified as soft powers. First on financials, the projects we think should largely self-amortize. So if these are successful projects, if you're building a port, or a toll road or a bridge or something that generates a revenue stream. The revenue stream should hopefully pay for the project. That's number one. But beyond that, if this is really the largest venture capital project in the world, how does venture capital work? You put in your seed money, you take the seed money out, but then you get a lot of other stuff coming in on the back of it. So there seems to be a lot of private money circling around Belt Road right now. As far as we can tell, the contribution of outside private money to Belt Road has been close to zero so far. It's all been Chinese governments or a branch of the Chinese government. So that one, again, multi-year, multi-decade framework, but has to be watched if we're going to assess financial success. And then number two is hearts and minds. So do BRI countries see themselves as part of a network that's sponsored by China, or do they see themselves as part of a program that's perhaps dominated by China? I don't know. There's been some tension in Pakistan and Sri Lanka. Projects are not generating revenue. In some ways, they're reverting back to the Chinese government under long-term leases. I'm not sure that was plan A, but that's indeed happening. And then, if you start looking at the map, we've got other powers in the region. We've got Russia, India, Iran, Turkey. A lot of these Belt Road corridors go right through these countries or through their spheres of influence. And is this going to be okay? Is this going to be, it could be led by China, but are there going to be any tensions there? Do Russia, India, Iran, and Turkey need to buy in? Again, as these projects come out and as we sort of see them develop, and then we get some private money in the back of these, we have conflicting spheres of influence. We'll see how that shakes out. My final thought here is about, this is my cynical slide, but BRI debt issues. So there's a infrastructure model. The infrastructure model is what these folks call BOT, which is you build the project, you operate the project, and then you transfer it back to the home country. So let's just take Pakistan as an example. There's an enormous deep water port being built in a city called Gwadar. It's being built with Chinese money, Chinese SOEs, Chinese laborers, Chinese engineering. The Pakistanis are borrowing money to finance this. Once the project gets going, it's operated. There's a revenue sharing scheme between the host country and China. Hopefully over that period, the project is amortized. And this is a long-term lease, 20, 30, 40 years. And then at the end of the lease, it gets transferred back to the home country. Some observers, again, the IMF, Christine Lagarde was in Beijing earlier this year. She warned about high debt for these countries. Will they be able to pay back the debt? The IMF wants to get paid back. The IMF has something called a preferred creditor status. So if country X gets into trouble and they're running short on foreign exchange, the IMF expects to get paid first. They don't want the Chinese to get paid first, so that was a concern as well. And then the question I want to leave you with, are these Chinese firms averse to getting the assets in the event of a default? So if you've got your Pakistan port or your Sri Lankan port and these projects don't amortize and the creditor ends up taking possession of the asset, is that necessarily a bad thing from the Chinese point of view? Because then you own all these strategic assets. Look at my map again. I will just leave that as a question. You guys can figure it out by yourself. I don't know the answer, but it's China's sphere of influence, but if the projects don't amortize, they end up owning the assets anyway, so maybe not such a bad plan after all. But something to think about. I will stop there. I've used up my 35 minutes, and I'm happy to take any questions. This is all public, by the way, so feel free to cite that or take photos, or we've got it lying around in various reports, so I'm happy to share those.
Thank you very much, Paul. This is a very impressive presentation. And can we have a copy of this?
Sure.
So maybe you can ask the office later in the club. I would like to open the floor to your questions. We start with Martin.
It's very formal. You can walk over here and ask a question.
Martin Kölling, Handelsblatt from Germany. My question is related to trade, and especially the protectionist movement in the United States and the free trade movement here in Asia. We had the Japanese parliament ratified the TPP last week. Last Sunday we had the RCEP conference here in Japan. It seems that the idea of free trade is very much alive in Asia. And I wanted to know from you, why is that? Why is Asia still so much interested in free trade, whereas in Europe, in Germany, and in the United States, from the right and left, the criticism starts to rise, or is rising?
Okay. Yes. I should give you another chart. There's a famous study by a professor at New York University. His name is Branko Milanovic, and he has something called the elephant chart. I don't know if anyone's seen the elephant chart, but I'm going to draw a picture for you in the air because you don't have it. So what the elephant chart shows is who has benefited from globalization. So too bad we don't have a chart here. So from where you're sitting, we're going to do a chart like this. The bottom axis, the x-axis, goes from 0 to 100. 0 is the poorest person in the world, and 100 is the richest person in the world. That's the x-axis. And then the y-axis here is going to be the gains from globalization over the last 20, 25 years, something like that. The average gain from globalization in terms of income is around 20, 25%. I can give you the exact number, but from where you're sitting, the chart looks like an elephant. It goes like this, and then it comes down to almost 0, and then it goes back up like this, like an elephant. Where it goes down to 0 there, that's basically the working class in the US and Europe. Thank you. This is in the Economist magazine, so Calden could send the reference around. I don't know if you can see this, but this is the big hump there is the Chinese and Indian middle class. Where it goes down to 0 there, that is essentially the working class in the US and Europe. And when the trunk goes up like that, that's the infamous 1% who benefits. That's the heads I win, tails you lose crowd. So the distribution of gains from globalization has been very skewed against the working class in the US and Europe, and I think that's why you're getting the pushback. A whole bunch of Chinese and Indian folks, tens of millions, hundreds of millions, have entered the global middle class because of globalization. So of course they want to keep the trade going. I think what needs to be figured out is a way to spread those gains more evenly. I think the issue that people lose, some people lose from trade, although the pie is bigger, some sectors lose. Retraining these folks, cushioning the blow, making sure that they can reskill and get back into the global economy. That's really the policy challenge. So the pie has been made much bigger from global trade but the distribution hasn't been very uniform. And again, it's the working folks in the Western world that have taken the biggest hit. Thank you for getting the chart. Good timing.
Yes, next question, please. Yes, please.
Süddeutsche Zeitung, Germany, too.
German guys are asking the question.
It's always like that.
Yeah, very good German core, the press club.
The US Treasury is a risk-free asset. Now, if all goes the way the Chinese government hopes for, how long will the US Treasury be the risk-free asset? For how much longer? Because, I mean, this is clearly the dollar will lose its importance in the whole Belt and Road project. And do you foresee a tipping point? I mean, the US dollar will not be 90% risk-free asset, 80%. It will tip at a certain point.
Okay, yeah. The death of the dollar story has been around for a while. So I think there are obvious concerns about U.S. indebtedness and whether that's sustainable. But the first fact is that there's no real alternative, right? So the three alternatives are the U.S. dollar, the euro, and the Chinese yuan. The U.S. dollar has been the global risk-free asset since the end of the Second World War. The euro's been kind of a steady number two, but we know of the architecture problems in Europe. I don't want to go into those today, but it's been number two in the ranking. China's a possible contender, but the Chinese yuan is not a free currency. So if the point of having a risk-free asset is you want to be able to, you want to see it as a store of value, and two, it has to be predictable. The Chinese authorities intervene in the foreign currency market. They still have capital controls in place. I would imagine if you took a poll of currency traders, again in our money centers, and you ask them, how much Chinese yuan do you hold in your portfolio for liquidity / security / store of value reasons? And I think the answer would be zero. They just don't do it because they don't see it as a predictable store of value. Because of the BRI, we will see a lot more trade in Chinese yuan. So the Chinese SOEs go into country X and they try to get the trade in Chinese yuan, but sort of a globally convertible, risk-free asset. Can't see anything replacing the US dollar for the time being. Australian dollar is a good candidate, but it's too small. Canadian dollar is a good candidate, but it's too small. So it's really amongst those big three, and I don't see any foreseeable move in US dollar 1, euro 2, and the Chinese yuan is still down there in the single digits. It's still quite a ways down. If and when the Chinese ever open the capital accounts, and I wouldn't hold my breath on that, they're going to do it very, very gradually.
How about the yen in this regard? The yen, Japanese.
Yen, yeah, it's sort of medium sized, but again, I would see, look at the basket. The IMF has the basket of the special drawing rights, which is essentially the accounting currency of the IMF. The currencies in there are supposed to be reserve currencies and freely convertible. China's in there for political reasons, but the other four are pound sterling and the Japanese yen, which I would say are kind of mid size in terms of foreign currency penetration. So dollar, euro are up here, yen, pound sterling are here, and then we've got some other ones, the Swiss franc, Aussie dollar, etc. But it's really dominated. The data I remember, something 80+% of reserve assets globally are dollar and euro.
Yes. Yes, please.
My name is Kondo Weekly Gendai from Japan. How do you think the U.S.-China trade spot influence to Japan, actually? Thank you.
I think the answer for Japan is probably similar to other countries. On impact, yes, there are tariffs, and yes, they will raise the cost of traded goods. But Japan's a huge economy, and I think on impact, the trade the tariffs are not going to really move the macro story. It depends on these second round effects again. So is it going to hurt investment? Is it going to hurt consumption? Are we going to see dislocations where production moves and other stuff needs to move? Japan's a pretty domestically driven economy, but I would say it's the same story as anyone else. The big countries in general, if you want a rule of thumb, the big countries in general will have relatively low impacts, I think. It's really the small, open trading economies. If we continue down the road of a trade spat or war, whatever we call it, those are the countries that are really going to see bigger shocks. If global trade really starts to slow down, it's not going to be the Chinas, Japans, and the U.S. that takes the big hit. It's going to be the smaller, open economies, the Taiwans or Korea's kind of mid-size, and Malaysia. Those guys more than the big guys. The big guys can take care of themselves, I think, for the most part. You just move the microphone to the
Corey Baird, the Japan Times. I was going to pretty much ask that same question, so I'll ask a little bit different of one. If global trade wars kind of kick up and we see a slowdown in growth, and I don't know if your background is monetary policy necessarily, but how do you think that could affect maybe the United States Fed, Japan, and even the Eurozone kind of taking their foot off the gas from monetary policy? Thank you.
Right. Well, central banks have a mandate. The Fed has a dual mandate. They want 2% inflation and full employment, and they see the labor market tight right now. They see inflation pressures rising, so they're steadily raising rates. That's a forward-looking exercise, right? They're trying to forecast, 6 to 12 months out, whatever the lag is for monetary policy, what they should do now, because it will have actions a year from now. If the view becomes that global trade's going to slow, global growth's going to slow, global inflation pressure is going to diminish, maybe the labor market starts to pick up a little bit of slack, we don't get so much wage pressure, then the central banks will dial back. The Fed's been pretty clear that they are data dependent. We have 4 rises for the Fed this year and 2 or 3 next year. That's on our baseline. If we go down a path where the trade war intensifies and things starts to slow down, that would sort of give the Fed reason to pause. And that's about all we can. That's about all we can say. Other central banks don't look at the labor market. The ECB and the Bank of Japan, for example, and Bank of England, they're just looking at inflation. But if growth slows and inflation pressures slow, central banks are going to do their job, and they're going to dial back the planned or the signaled sense of monetary tightening.
Siegfried Knittel, also from Germany. I think China wants to make the yuan to an important currency. So why are they not interested to make the yuan to a free currency? So I think it would be the best way to get the #1 currency. Okay.
I'm not so sure that if again, I'm not a insider. I'm not Chinese, but watching China over the last 2 decades, I'm not sure having the yuan as an international currency is a top priority. Okay, the top priority is stability. The top priority is to keep growth high and keep people happy and stay in power. If the Chinese authorities, and this is my mea culpa, the one mistake I've made repeatedly in China, and I have made some mistakes in China, is I underestimate the need for stability. So if the Chinese government needs to reimpose capital controls in order to stabilize the currency and that helps stability, they will do it. If they need to dial back on the pace of economic reform because they don't want too many defaults because that will increase instability, they will do it. If they need to put controls in the housing market in order to slow things down, and these are non-market controls, they're very heavy-handed, they will do it. If they need to forestall the time at which the currency currency becomes internationalized because they don't want all the volatility, they will do that too. So everything revolves around stability, achieving their targets for doubling per capita GDP this decade, and sort of keeping control. Letting the currency be freely determined in a market that they don't control, I mean, that's a nice status symbol to have in becoming a world's reserve currency, but I think that's a secondary, I think honestly that's a secondary objective of the Chinese authorities. They will eventually over time loosen up the reins on the currency, but it's not going to be a straight line. We're going to have forward and back. But if the cost of having an international currency means less domestic stability, they won't do it. That I think is pretty clear. They will go slowly.
Second round, and I stick to trade. So when you look at the discussions going on in Asia right now with RCEP and so on, they have again formulated a pretty aggressive and ambitious goal to come to an agreement of some kind end of this year. So how do you think these discussions will play out in this free trade arena in Asia? So where will we see the most progress? TPP, RCEP, trilateral free trade agreement, Japan, Korea, China. So what movements do you expect in the near future to play out?
Yeah, I think it's going to be a little bit of everything. I mean, the TPP 11 is already sort of in place, right? It's without the U.S. RCEP gets, at least from what I can tell, living in Singapore, kind of a lukewarm reaction. Some of the bilateral deals are going through, but the way I would answer that question is to look at what the U.S. has provided since the end of the Second World War. The U.S. Was essentially underwriting a global system that was based on markets, it was based on trade, it was based on rule. It was based on kind of openness, and anyone who wanted to join the platform could join the platform. It wasn't restricted membership. The U.S. is clearly pulling back from that position under the current administration. And again, I think the big guys can take care of themselves, but we've got a bunch of small and medium-sized countries in Asia that benefited from joining the system that was underwritten by the U.S. We have the Tiger economies and others, and these, in my view, are the ones to watch. Will they be able to continue to grow and prosper and trade, or are they going to be squeezed in a system where the platform no longer exists and we've got bilateral deals between the big guys? I think that makes a number of country authorities nervous that the platform that used to be there, again, trade markets, openness rules, etc., may no longer be there. So again, if we go down the bad scenario, those are the kind of countries where you might see a bigger impact than the other ones. I don't think anything, maybe to answer your question more directly, I don't think any of those initiatives is really going to replace what we had before. Those are going to be sort of smaller, more modest agreements, less comprehensive.
Thank you. Let me ask a question, please. You mentioned that China and India are depending more on the Middle East oil to avoid, for China to avoid Malacca Straits. And also, China is focusing on the energy sector in its Belt Road initiative. We know that American administration is asking for a global ban on buying oil from Iran, and China rejected that, and they said we will keep depending on Iran for our oil imports. How do you see this confrontation would impact the trade wars in general and the issues in the region in particular? Thank you.
Yeah. Well, as I said, China and India are both big energy importers, and I'm not sure they have the luxury of being picky, right? So if you're a net energy exporter, you can be a little bit pickier about who you who you deal with. The Iranian minister was in Switzerland yesterday, right? So I'm not sure that we've got total harmony across that particular issue. But that's just an example of something we will see more of, which is traditionally the U.S. has been very interested in what's going on in the Middle East because of its oil dependency, and with the shale revolution, that is now largely a thing of the past, at least on a net basis, and the need for oil supply out of the Middle East is swinging toward China and India. So I think that's a kind of a precursor of something we're going to see a lot more of in the decades ahead. Just as an aside, I thought you were going to ask a different question, but I'll answer a question that's come up before. China is making a big push toward renewables. That's what I thought you were going to ask. And, electric cars, wind, solar, that sort of thing. The group I sponsor, our China analyst group, also tackled that issue last year. And where we came out is, even if China gets to the target of 50% energy produced by renewables in the next generation, they're still going to be the biggest energy importer in the world, and it doesn't change that narrative. China and India cannot follow the same energy intensity path as the US and Europe did. They're going to have to find a much less energy intensive path. Even if they go to renewables, electric, solar, and wind a lot earlier than the US and Europe did, it's not going to solve this problem of Middle East dependency. They're still going to be very dependent on what goes on in the Middle East because of the oil. Energy more generally, oil and gas.
Talking about the freelance, I have two questions. The first question is about, could you tell us your opinion about the potential investment opportunity in North Korea?
Okay. After
we confirm that Kim Jong-un...
I have no idea, so I can answer that one very quickly.
Okay. And the second question is, you showed that, how Japan and Asia particularly Japan depend on the Middle East oil.
Yeah.
And do you think that, once again, this indicates that we can justify our nuclear power plant project in Japan?
Okay, those are very kind of micro questions. Well, let me go back to my map. Okay, one of the things I think is I don't understand. Let me go back to, where did I go here? That one. I talked about that choke point, right? So you can read about this in the sort of the Chinese analysts and things out of Beijing. The worries about that choke point at the Straits of Malacca. So all the energy comes from the Middle East around there. But that energy doesn't just go to China. It goes to Japan. It goes to Korea. It goes to Taiwan. It goes anyone. All this stuff going through the South China Sea comes to Japan as well. So on your second question, not just a nuclear thing. I just think diversifying away from fossil fuels is the way of the future, whether it's electric cars or wind or solar or hydro or whatever. Every country in the world, Japan, I think, is one of the leaders, if I'm not mistaken, where if you look at the energy intensity per unit of GDP is quite modest. The US is not known for its energy efficiency, so they're very high, but I think Japan is pretty good on the measure of generating GDP with relatively low energy intensity. I don't know between nuclear or any of the other non-fossil fuels. That's a policy choice, but that's clearly the wave of the future, and everyone is pushing to get there. Oh, by the way, another thing that popped into my mind: if you look at some of the Paris Accord targets, and I know the U.S. dropped out of the Paris Accord. The market is already ahead of those targets. So the energy efficiency gains that were supposed to be, that were agreed in the Paris Accord, which weren't binding anyway. The U.S. and other countries are actually doing better than those agreements. The technology is progressing faster than was initially thought. So as in other things, this starts to move very quickly, and now even some of the more I would say positive energy scenarios are not looking that unrealistic as the adoption of solar and the cost of solar goes down, the adoption of electric vehicles picks up. So some of those scenarios that looked a little bit, pie in the sky ambitious a few years ago, now they don't look so bad. So that's part of the bigger picture. Japan's obviously part of that mix.
Thank you very much. I think, yes, last one, please.
Last question, okay.
Yeah, since you just got a micro question, I have a macro question. Referring to your answer about RCEP and TPP-11 and the answer you gave to me about the dollar. One of the biggest advantage of the U.S. of the Bretton Woods system was that it included more or less, it includes more or less everybody at the time, except for the Soviet bloc that didn't have much of an economy anyway. Now, can you imagine a point where this including everybody system would break up into different systems? I mean, seeing China growing so economically powerful in Eurasia that it doesn't go everything through New York anymore, and so we wouldn't have any lead currency, any risk-free asset anymore.
I mean, you can imagine a point. There tends to be a global risk-free asset, right? It was pound sterling before, and then that one went away, and then it was a U.S. And I'm not sure these things move very abruptly. In terms of the global order, I sincerely hope that the IMF and the World Bank and the OECD and the UN and all these guys stick around. I mean, this is we're going through that. To go back to that elephant chart, we're going through this very disruptive period, and I think there's been a lot of sort of distinction between the winners and losers of that. Hopefully that settles down and we go back to sort of a similar order to what we had before. But it's an enormous, all this technology is an enormous shock to the global system, economic system, political system, all the immigration, all that kind of stuff. The hope is that that just settles down and we go to a different system. What's going to change is the weight of the emerging markets relative to the so-called advanced markets, the G7, and one of the consultancies put out a paper. They called it the E7, emerging markets, China, India, Indonesia, Turkey, Brazil, South Africa. I can't remember everyone in there. And they looked at the E7 versus the G7. The E7 pulled even with the G7 in 2015, and by 2050 they're going to be 4 times as big. So we just have to, the global order, whether that's the IMF or the World Bank or the UN, those structures will probably just stay in place, but the weightings within those structures has to reflect the new reality, and the new reality looks different from the old reality. So the rise of China, India, the other EMs, Indonesia, Brazil, that just has to be accommodated within the system. So the former countries that were running stuff have to make a little room for the new guys. That has to happen, right? Just mathematically, that has to happen.
Well, thank you very much, Paul. This is very good to hear about all of these and learn a lot of new elements. We'd like to present you with honorary membership to our club for 1 year.
Wonderful. Thank you.
Whenever you are in Tokyo, please visit us again.
I will do that. Thank you very much.
Thank you very much, and have a nice day.